But I will say this, never in history have we ever had a time where the alternative pathways like uplistings have outpaced the traditional initial public offering. Have you ever wondered what's really happening inside the emerging growth markets, or why some companies are able to get public, raise capital, and grow, while others just struggle to get through the process? Welcome to Inside the Emerging Growth Markets. I'm Joseph Lucosky, managing partner of Lucosky Brookman, Wall Street trained, founder focused, and for the last 2 decades, I've advised hundreds of the most ambitious and committed entrepreneurs, investment bankers, and investors across some of the most active and dynamic parts of the capital markets. Whether you're preparing to go public, navigating life as a public company, or operating inside the emerging growth ecosystem, this briefing is for founders, public company leaders, and other capital markets professionals who want to understand how this market actually works today. My goal is simple: to give you a real, clear-time view of what's happening inside the emerging growth markets, and more importantly, what you should be doing about it. In each episode, I'll break down what we're seeing from the trenches, from IPOs to uplistings and direct listings to reverse mergers, SPACs, secondary offerings, and the ever-evolving regulatory landscape, so you can make better decisions and execute at a higher level. If that sounds good to you, then listen in, because in this market, understanding how it really works can make all the difference.
My name is Caroline, and welcome to Inside the Emerging Growth Markets with Joseph Lucosky. On this show, we take some of the most current and pressing questions on the minds of those of you in the emerging growth and microcap ecosystems and break them down in a live question and answer format for Joe to give you his take from the trenches. So before we get into today's topic, Joe, can you just give us an update on what you're seeing from the front lines of the emerging growth world?
So thank you, Caroline. I would say the biggest thing right now that I'm seeing is the market is getting more active, especially coming off a very difficult first quarter. But I'll say that the margin of error is still much smaller. I mean, there's definitely still opportunity in the marketplace and deals are still getting done. But that old idea that you can just show up and check some boxes and somehow get through the system, well, that's gone.
Yeah, that's really helpful, Joe. And at least so far, it does seem like the second quarter is shaping up a little bit better than the first.
Well, as of right now, that's what the data is telling us. And I'm hopeful that that's going to continue as the year progresses.
Okay, Joe. So today we're going to talk about uplistings. And we'd like to hear from you on why uplistings are getting more attention in 2026 and why they may actually be one of the smartest paths available for the right company right now.
Well, that's great because uplistings are definitely one of my favorite types of transactions. So I am really happy to be talking about them.
And I figured you would say that because I've heard you say many times that you love the uplisting process. And I've talked to some of the other members of the firm around the office who also say the same thing. But I've heard you say that sometimes uplistings are misunderstood. What do you mean by that?
Well, I think a lot of people hear the word uplist and they think somehow that it means a lesser path, or they really confuse it with a traditional IPO. In this market, for the right already public company, an uplist may actually be the best path forward. And by the way, I still do love these transactions very much. You are correct.
Okay, Joe, let's start right there. What is an uplist by definition? And maybe just as importantly, what is it not?
Okay, that's a great place to start, Caroline, because at the most basic level, an uplist is when a company that is already public and already trading, usually on the OTC, moves up to a senior exchange like NASDAQ or the New York Stock Exchange.
And what is not an uplist, so to speak?
So an uplist is not a traditional IPO where a private company goes public for the first time. It's also not when you move from a lower tier like the OTC, OTCID, OTCQB, or OTCQX, and you move within those tiers. That may be an upgrade to your current trading status, but it's certainly not a uplist transaction.
So let's get into some of today's questions. And for those of you that are new to the show, these are real questions coming out of the market right now from companies, boards, investment bankers, and even live deals. So if you've got a question, please send them to us at questions@lucbro.com. That's questions@lucbro.com, and we might cover it on a future episode. Let's start here, Joe. Why are uplistings gaining so much steam right now?
Well, Caroline, that is the million-dollar question. And I know we've spoken about this in the past. You see, the traditional microcap IPO market got a lot tougher, as you know, because NASDAQ passed their new discretionary rules in December 2025. So naturally, that market started shifting and slowing down to alternative transaction structures. And the uplist is just one of those alternative pathways.
All right, and just break that down a little bit more for us.
Well, you see, as the IPO process gets much slower in this selective market, the industry and its professionals, I believe, started putting a lot more energy into these alternative pathways, especially already public OTC companies that have a real and viable route to a senior exchange. And by the way, this includes direct listings and cross listings too, and even reverse mergers in certain contexts. So these alternative pathways are just getting a lot of steam and a lot more energy from the industry professionals. So the microcap market didn't go away just because the IPO slowed down. It just started rerouting into different structures.
All right, and before we get in too deep into structure and execution, just give us a quick sense from the data. Are uplistings really taking off, or is this just something people in the market are talking about more now?
No, the data actually shows that uplistings are gaining real traction. And part of what makes this so fascinating, Caroline, is that when you compare the data from 2025, meaning the quarter over quarter or year over year to 2026, you can see this showing up in a real way. So in 2025, we saw 19 uplistings for the entire fiscal year. Right now, we see 13 already on the board, and we still have 6 months left of the calendar year.
And Joe, what is the makeup of those 13 uplistings? Does the data tell us?
Yeah, I mean, we break this down from the Lucosky Brookman data desk pretty granularly. And I'll tell you that, remember, in 2025, the foreign private issuers dominated the IPO market, meaning they were, 85+% of the IPO market. And the domestic companies were obviously a lot less. This year, the IPO market is littered with domestic companies and very few foreign companies, except, and here's the real point, except in the uplisting world. In the uplisting world, foreign private issuers that are already trading on the OTC seem to have an easier path to a senior exchange, unlike the IPO market.
Okay, so wait, that's really interesting, but why do you think that's the case?
Well, that's an excellent question. And the reason I think that is, remember, the IPO has been deemed, sort of very risky and a volatile transaction for most of 2025 when it comes to foreign issuers. Because depending on how a deal is structured, there could be, lots of demand, not a lot of supply, and sometimes a very highly volatile trading situation, after the open in an IPO. And we all know what happened in 2025. NASDAQ went and passed a whole bunch of rules and, tried to really crack down on that volatility. But an uplist, as you know, is really already trading on the OTC. It's a very different sort of animal. And most companies that uplist, they're generally not raising $15 or $20 million. So they don't have all this pressure coming out of the gate like an IPO on day one. They can take advantage of some of the uplist exceptions, as we say, and I'm sure we're going to get to here in a minute, to ease the pressure, ease the concern, and make the transaction maybe a little bit less scary for the exchanges.
So we're definitely going to get to that in a minute, but before we get there, can you just tell us, are all uplist transactions the same?
No, they are definitely not all the same. And at a high level, I really think of them in two buckets. The first is what we call the organic uplist. That's where the company really uplists without raising capital for the most part. I mean, they still have to do the reverse split or the reverse consolidation, maybe clean up their structure, but they're generally not doing a financing as part of the uplist. And the second bucket is really the more traditional uplist with a financing where you file a registration statement and, you basically get uplisted, you raise some capital, and that's what mainly people refer to as a uplist.
And from a practical standpoint, why does that distinction matter?
Well, because they're very different setups. Remember, an organic uplist can be attractive because you're not forcing the company into a capital raise or a registration statement. It's really that just, you do the reverse consolidation or reverse split and you list many cases without much else.
And what about a regular uplist?
Well, a regular uplist is really financed and you need a banker for the most part, or you need to file a registration statement and you basically raise a bunch of money to either help support the balance sheet, meet some of your qualitative or quantitative requirements, increase the sort of distribution or the trading story, whatever metrics you are trying to improve, or just have cash for working capital. But most of the time, you have to go through that SEC registration process, and that can really slow down the workload in a real way for an uplist.
And do you know, and can you tell us how many uplists were organic versus those that raised capital?
Yeah, I mean, traditionally, the ones that were organic seem to fare a little bit better in the marketplace. But I think right now, according to our data desk, at least for 2026, it's about 50-50, both organic and non-organic uplists, meaning those that just did a reverse split and listed versus those who, raised money through a registration statement.
Okay, but let's make sure everybody understands that correctly. So you're not saying private companies just started choosing uplists instead of IPOs like they are picking off the same menu, right?
No, of course not. No, they're still in the different buckets that we talked about earlier. I mean, let me explain it this way. And I've said this, many times, but I think it's a good idea that we level set a bit here. Remember, private companies, they generally do IPOs. OTC traded companies, they uplist to a senior exchange. And foreign issuers, they may uplist or cross list depending on their situation. So what's really changed is not the identity of the companies, Caroline. What's changed is the focus of the market.
So let me ask you this. Why did the focus shift so hard towards uplists?
Well, because aside from the IPO market slowing down because of those discretionary rules that we talked about, for the right company, an uplist still maintains one of the most meaningful exceptions to the now familiar gross proceeds rule of $15 million dollars in connection with a NASDAQ IPO. I mean, this is a very, very big deal in the market. So if you're an already trading OTC company and you satisfy the right trading and structural requirements, you may be able to get to a senior exchange without raising that forced $15 to $20 million dollars under the gross proceeds rule that everybody conducting an IPO must raise.
All right, and that's the part I want to slow down on for a second because that's the real value for people listening. Why is that such a big advantage?
Well, because the $15 million gross proceeds rule for emerging growth listings changed the landscape dramatically last April when that rule went into effect. And a lot of companies that might have had a real chance in an earlier market, say in 2024 or 2025, now must force that kind of capital raise that may not be realistic. Because remember, oftentimes the bankers aren't even able to raise that kind of money for an emerging growth company.
Right, I can see how that would be tough.
Yeah, and frankly, I've been talking to the exchanges almost every day about these types of listings and more. And it really doesn't feel like $15 million dollars anymore, Caroline. I mean, we've been told pretty clearly by both exchanges that deals that start with a two are going to have a better chance of getting approved on a timely basis.
So, Joe, let's go there for a minute. If somebody is actually thinking about an uplist right now, how differently do NASDAQ and the New York Stock Exchange look at these deals?
Well, for the most part, the building blocks are the same. You still have to meet the listing standards and you still have to sort of deal with the reverse split mechanics. But after that, the paths really start to diverge a bit.
Okay, yes, that's exactly where I wanted to go.
Yeah, remember, for NASDAQ, you really need to see actual trading and not just some weird burst of, trading activity that appears out of nowhere. I mean, you're generally talking about something like 2,000 shares a day for an average of, 30 days of trading and preferably a lot more. And ideally, that trading profile will develop in a gradual and credible way over time, not just show up out of nowhere 30 days before you make your, listing application. But I also want to be clear about something. Just because you hit an average of 2,000 shares a day for 30 days doesn't automatically mean that's not enough, meaning that, the exchanges could ask for more. So while it is a rule, it is really a guideline for approval.
I've heard you actually say that before, but what do you mean by it may not actually be enough?
Well, remember, Caroline, the exchanges look at this as a holistic review. No factor gets judged anymore in a silo. So if you're weak on, certain factors and your trading must be very strong. If your trading is average or weak, then you better have better metrics to go to the exchange with and show them why you're worthy to list. So if a stock starts trading suddenly out of nowhere, NASDAQ is going to ask why, and frankly, they should.
So the issue is not just volume, then, it's whether the volume looks believable.
Yeah, that's right. I mean, if it looks manufactured or if it looks like somebody's trying to create some sort of quick trading record just to game the uplist process, then that's going to be a problem for the exchanges. I mean, the whole point is that the company has to look and feel like a growing public company building real trading support over time.
And what about the New York Stock Exchange?
The New York Stock Exchange is slightly different. They do not really have that same 30-day volume rule framework in a way that, Nasdaq does. But you still need to be trading. They may run the math a little bit differently on the reverse split. They may look back at the trading profile over time and really look at it in a more holistic view. So, in some situations, if the structure and the trading look good, New York Stock Exchange may be a bit easier and faster to get through the uplist process. But I want to be careful here, though. I did not say easy. I said maybe a bit easier, assuming you get through all of the other sort of listing items. And most importantly, you have the right advocate who knows how to get you there because this market is no longer a straight line path for any of the structures that we've been talking about.
And is part of that difference also the application process itself, or is it really just about the trading profile?
No, it's a little bit of both. The core submission process is formal on both exchanges, but neither one is something that, you can really take lightly. But in practice, I'll tell you, Nasdaq can feel a little bit more tied to the trading story and the pattern and really how the market sort of forms around the company. The New York Stock Exchange in some cases can feel a little bit more holistic in how it looks at the overall setup. So one thing that I would recommend to anyone going through this process is to really get a good handle on your trading every single day. Get a Bloomberg print, keep an Excel spreadsheet, use AI, whatever it takes, but know your numbers. And also stay in good communication with the exchanges. They're not there to do your homework for you, Caroline, and they're not going to track this for you. You need to stay on top of it yourself, and you need to keep updating the exchanges throughout the process, again, with the right advocate.
So it seems that exchange choice really needs to be a strategy and not just an optional consideration anymore. Is that right?
Yeah, that's the case regardless of the trading requirements. People talk about the NASDAQ versus New York Stock Exchange like it really doesn't matter anymore. But in a live deal, I can tell you from the trenches, it can be a real execution decision point. The timing, the trading profile, the split mechanics, I mean, the entire approach of the listing, all of that matters.
All right, so let's stay there. If somebody is listening and thinking, fine, we'll just get some volume going on the OTC and then uplist, what would you say to that?
I would say that is exactly the wrong mindset. And whoever told you that gave you really, really bad advice. Manufactured trading is never the answer.
Well, what do you mean by manufactured trading?
Well, if the market is going to reward the uplisting path, and let you take advantage of some of these, exceptions, then it has to reward robust companies with real trading and real investor interest, not some setup just to exploit, the exception. That is why the entire process still needs to be credible and done right. And most importantly, with the right quarterback or right advocate.
So this is not a loophole then, it's something more?
No, it's absolutely not a loophole. It's an alternative path, and that is a very, very different concept. A legitimate uplist is not supposed to be a gimmick. It's supposed to be a path for companies that have already been living and breathing as public companies. They've been building a market. They've been proving they can function in an environment, but really, really need something more. And that more is a listing on a senior exchange for whatever reason. And that's not right for every company. And it's certainly not right for every trading profile.
So let's talk a little bit about reverse split mechanics because I know that's another place where people are getting tripped up.
Yes. And I'll tell you, reverse split mechanics matter a lot.
All right, so tell me what you mean by that quickly.
Well, one of the practical problems in uplist is that companies often have to lock in a split ratio too early, and they really have to go through the FINRA process, which sometimes can be, very cumbersome. So if a stock is moving before the split is effective, after you've put in your application, you may have a real execution problem on your hands, depending on how you deal with FINRA. So timing matters and exchange choice matters. Really, the whole structure of the process matters in any of these uplist transactions.
All right, Joe, so let's stop right there. For people listening who may not live in this world every day, what exactly is FINRA's role in this process?
Well, On the OTC side, the over the counter markets, if you're doing a reverse split, that must be done through something called a corporate action, meaning the reverse split must be processed and approved by FINRA. So this is not just some internal company decision and board approval or shareholder approval where you snap your fingers and it happens. This is a real regulatory process attached to the reverse split, and that process takes time.
And how much time are we really talking about right now?
It used to be, 4 to 6 weeks back in the day, but right now it's taking a lot more. I mean, I know this is not going to be a popular answer, but I promise you it is correct. And this is coming directly, by the way, from our head paralegal who has worked with FINRA for over 15 years, basically every single day. So it's definitely correct. And I'm telling you, a good timeline for FINRA to get through the process is about 12 to 14 weeks right now on average. Now, look, sometimes we get these things through a little bit faster. Sometimes we get through a lot faster, but I do not believe you can bank on that. You should allot for 12 to 14 weeks. And by the way, Caroline, this is one of the biggest mistakes people make in the process because they get into the uplist process, they forget about the split, they forget about FINRA, they're 3 or 4 weeks away from listing, and then bang, FINRA comes out of nowhere, and now they're delayed. So don't treat this uplist process as a backwards timeline. Get ahead of FINRA early.
Can you just give us a quick real world example of what that looks like when people get it wrong?
Yeah, I mean, this happens more than I care to admit or really would love to happen for the industry. So about a month or two ago, we were brought in as special counsel on a deal that was really later in the uplist process. And we realized after getting, in with the company and looking around that they hadn't even started the FINRA process. Meanwhile, everybody was hoping to be on NASDAQ within 3 to 4 weeks. I mean, their registration statement was coming to an end. NASDAQ was looking good. The company was performing, but that situation became a real scramble. Everybody had to push really hard. We had to use our relationships with, FINRA and just the people that we deal with and really figure out a path forward for this deal because they had forgotten that the timeline can be so long with FINRA and really didn't understand the reverse split mechanics. Can't tell you how many people think that by doing an uplisting that NASDAQ is in charge of your reverse split. That is not the case. You must do a corporate action through FINRA and it will take 12 to 14 weeks on average.
So the real lesson there seems that FINRA is not something you deal with at the end. It has to start much earlier.
Exactly. I mean, FINRA is one of those things that you can never start too early. I mean, the whole point of the uplist is tied generally to a reverse split. So please remember, FINRA is viewed by the industry as, a very slow bureaucratic organization. Now, that's not me speaking. That's not my opinion. That is what everybody in the industry says. So every single day, you can't assume that they're going to do anything on time, anything correctly, or help you out in any way, shape, or form. You have to go through that process and press on them, get your corporate action done, and really get your deal to that finish line. Now, I'm not saying FINRA is bad or anyone at FINRA is a bad person. What I am saying is that you cannot trust the process because they are not there to process these reverse splits as quickly as they can. They are there to regulate the markets, understand the file, and then eventually in 12 to 14 weeks, as we have found, you generally will get a decision if your application was proper, all your information was there, and you've, structured it correctly.
Okay, but there's another problem here too, right? Because FINRA doesn't just let you apply with a range on the reverse split.
No, that's right. And that's what I alluded to a little bit before. I mean, the application for FINRA, you really have to put in a hard split number. And, when you're doing this early in the process, you may not know what that is because the stock is breathing, it's trading, it may be up, maybe down, it may find new lows, new highs. So you really have to be careful because it gets really tricky really quickly.
So in other words, you're making a pretty important call earlier in the process than a lot of people realize.
Yeah, exactly. And that's where it gets to be a little bit of a guessing game, unfortunately, because you're picking a reverse split mechanic so early in the process instead of a ratio like you would do, when you were on NASDAQ. Now, the good news is you can replace that reverse split mechanic later in the process. Generally, it doesn't cause a material change in the application. and you can proceed on your way. But the reality is you want to get as close as possible as you can to that reverse split ratio on day one.
And what happens if you guess wrong?
Well, like I said, sometimes you could have a real problem on your hands. But in our experience, if the stock weakens and you need a bigger reverse split, or the stock goes up and you need less of a reverse split, which is, an amazing situation to be on, it really could delay your application. And we found it's kind of hit or miss. Sometimes it doesn't really affect your application. Sometimes it could throw it into a tailspin because of a material change. So the best advice is for everyone out there doing a split for an uplist is to try to nail your split ratio early in the process, and don't play guessing games where you hope things will be, where you think they'll be. Just say the ratio. And if you have to change it later, they'll change it. But most of the time it doesn't change. And then your process won't get delayed and you can move it along to NASDAQ, when you get your approval.
Okay, so timing and picking the most accurate split ratio you can are both real issues, but there is another FINRA issue people really need to understand too, right? I mean, this is not just about timing and split ratios. There is also a public interest overlay.
That is a super important point because a lot of people still think that FINRA process is basically administrative, meaning you file a reverse split, you wait your turn, and everything gets processed. Well, that's not how it works anymore. A few years ago, the rules changed under something called Rule 6490, which gave FINRA the ability to use discretion in the name of public interest in approving these transactions, either reverse split or name change and so forth. So FINRA isn't just checking boxes anymore. They do make judgment calls, and that can have a real effect on your timeline and your deal.
Okay, so what does that actually mean in practice? I mean, when does FINRA start using this discretion?
Well, a lot of times it comes up when there are bad actors in and around the company, or when FINRA may perceive there's bad actors, lurking around the company. And generally you see this when companies have convertible notes or other loans with people that may have regulatory history. Now, this has been a little bit of a controversial topic lately because the SEC had sued a bunch of these convertible note holders under some rule that didn't exist, although they thought that it existed. And then, the new administration came in and got rid of all that. So some people were on this bad actor list for FINRA that really probably shouldn't have been, but that's usually when it comes up. If you have the wrong note holder in your cap table, or someone with bad history, or a real bad actor, then that can really be problematic. And I will tell you, FINRA will not let you move forward unless you get rid of that person, convert that note, pay off that debt, because they will hold this public interest standard, to your deal.
So the lesson there is this isn't just a filing exercise, it's also a diligence exercise.
Yeah, there are no more filing exercises in this world anymore. That was a 2024, 2023 concept. I mean, now with the exchanges, the SEC, FINRA, everything is an analytical, advocacy-based process. So before you even apply, I would say you should be doing some really good diligence on who's in your company, who owns shares, even on an equity cap table. I would look. If you have bad actors or perceived bad actors that are greater than 5%, even 4%, 3%, we have seen FINRA object. You should try to restructure that and do real diligence up front, so the FINRA process doesn't go from 12 to 14 weeks to, 25 to 30 weeks.
So between the timing, the hard split ratio, and the public interest review, this is a much, much more strategic process than people think.
Absolutely, it's a much more strategic process. I love these people that run around the industry and say, we're going to send a letter to FINRA, do a reverse split. That is not the way it works. It is not clerical work. The reverse split process, can look simple from the outside because, you're just doing math. But if you don't take the approach that you have to do real due diligence, be thoughtful, be thorough, it can really hurt or otherwise derail your entire deal.
So can we just turn to what actually gets these deals done now?
Yeah, I mean, I've said it before, I'll say it again. Right now, the theme in the marketplace is bigger, cleaner, better prepared companies with robust, growth-oriented businesses, and most importantly, the right advocates, the right advisors, and the right structures to get you from where you are today to where you want to go tomorrow, which generally is a senior exchange listing with the NASDAQ or the New York Stock Exchange. This is not the kind of market, Caroline, where paper pushers are getting you through the process.
Yeah, that sounds like one of your favorite lines.
Well, because it's true. Okay, it's true. Deals in this market, they need real advocates, real quarterbacks, real people to get their deal to the finish line, not just people or advisors moving paper from one side of the desk to the other or sending an email. The companies that do well are the ones that treat this process like a full contact sport, not just some paperwork and an application-based process.
Okay, but let me just push you on one more thing here. If uplists are gaining steam, is that really a healthy sign? I mean, or is it just proof that the traditional IPO market is broken at the low end?
It's both a response to the IPO market slowdown, and it's also a sign to the market that these alternative pathways can gain traction. I mean, it's a response because I think the market has adopted or adapted, I would say, really well to the IPO slowdown. But it's also a sign that these alternative pathways can become a much more important part of the emerging growth ecosystem. And frankly, it's not necessarily a bad thing. It just means that companies and advisors have been a lot smarter about the way they're investing their time and the selection of these deals and these pathways.
All right, Joe. So, bottom line, what is the one thing that you want people to remember from this episode?
Well, I would say this. The uplisting market is really heating up because the market is adapting, as we talked about, to a much tougher IPO environment. And for the right public company, an uplist is no longer some backup plan or some lesser thought. In a lot of cases, it really may be the best plan.
And what should people be watching next?
Well, I think people should really be looking at and watching for real trading quality within these companies. I mean, keep your eye on number of uplists as they continue to unfold throughout the second and third quarter. And I will tell you, though, I do believe that the IPO market, and I know we'll probably talk about this on another show, is starting to loosen up a bit, and the numbers that we're seeing in the data are starting to grow. But I will say this, never in history have we ever had a time where the alternative pathways like uplistings have outpaced the traditional initial public offering.
You've been listening to Inside the Emerging Growth Markets with Joseph Lucosky. For more insights from the trenches of the emerging growth markets, follow Joseph Lucosky on LinkedIn or subscribe to him on Substack. And if you found this episode helpful, please share it with someone in the market. And remember, if you have any questions, please send them to us at questions@lucbro.com. That's questions@lucbro.com. Thank you for listening, and we look forward to next time.